Ron Insana, welcome. Good to have you with us.
Indeed, even more so after yesterday.
That's right. That's right. Walk us through this yield curve conundrum here and what it tells us and what it doesn't tell us, and why one yield curve, the 2 to 10s, might be inverted by a little bit, but maybe even a more important yield curve, the 3-month to 10-year bills, is anything but inverted.
Yeah, and Tyler, you and I don't know how many times we've talked about this over the course of the last several decades, but the original work done on the yield curve by Arturo Estrella, who was at the New York Federal Reserve, since retired, was really focused on the 3-month to the 10-year relationship. And the 3-month yield is significantly below that of the 10-year yield. The 2 to 10 spread has, as you and Kelly both said, inverted. And Arturo has told me on many separate occasions that it's not the spread that is most closely watched by the Federal Reserve. It's the 3-month to the 10-year. And that is a long way to go before inverting. And yet, given that the Fed's expected to raise rates by a half point next meeting and possibly the meeting after that, we could see a significant flattening of the curve and that more important curve getting to the point where it's flashing a yellow or red warning sign about the imminence of a recession. Now, the average time from a yield curve inversion to recession is somewhere between 9 to 15 months. The average is 12. Could speed up a little bit depending on Fed policy moves. But again, I don't think we're fully inverted, although that 2s to 10 spread is at least a yellow warning sign that the economy is either slowing now or will slow in the immediate future.
One of the points you make in your op-ed is that it used to be that there was a long delay or a long-ish delay between whether it's the yield curve inversion or the Fed raising interest rates or signaling that it was going to raise interest rates and economic effects. But you say that this is a different era. I certainly agree with you because it's all about speed now, and the Fed is far more transparent. One can question whether that transparency is always helpful, but it's far more transparent than it was, say, under Volcker or Miller or Greenspan.
Oh, gosh, yeah.
Yeah.
And Tyler, you and I both go back to this era, as do a couple of our colleagues, where, not only did we not know what the Fed was doing on a day-to-day basis, they would add or drain liquidity from the banking system, sometimes on a temporary basis, sometimes on a permanent basis. But back in the 80s, the Fed wouldn't even tell us that it changed interest rates until after the fact. It was a confirmatory statement long after something had already transpired. The Fed watchers grew up watching those daily interactions by the Fed, watching the size of the money supply every Thursday afternoon. Now they're so transparent. They not only tell us what they're doing, they tell us what they're going to do. So if you look at mortgage rates, for instance, now, they move in real time.
Yeah.
When you and I were younger, they were based on something called the 11th District Cost of Funds, which was an interest rate that changed monthly, and it lagged when the Fed made its move. So I think the notion that the Fed operates with a lag or monetary policy operates with a lag is entirely archaic. And I think the speed with which the Fed is moving now may have a more pronounced impact on the economy in the nearer term, which might be why the curve is flattening so quickly.
Shepard Smith here. Thanks for watching CNBC on YouTube.